your biggest asset is really your future earning potential. And so your best strategy is to invest into growth assets and allow time in the market to build your wealth. But at a certain point, that changes. And you really need to balance both the risk of not losing money with growing that money and making it last for as long as you can. So the real return fund is really about a very simple principle, that the best way to make money is not to lose it. The investment objective of the Real Return Fund is to generate inflation plus 5% over rolling 5-year periods. And so the way we think about building the fund is to break it into what generates the return and how to manage the risk. So we think about 4 parts to the fund. The first part is around inflation. What assets will protect you from a spike in inflation over a 5-year period? And so we look at things like inflation-linked bonds, commodities and properties where rents are tied to inflation. The second part is really about generating returns. So we're looking to find asset classes that meet our CPI plus 5 objective. And that could be across small caps, Australian equities, global equities, infrastructure debt, to name a few. The third part is around diversifying opportunities, and these are opportunities that are typically overlooked by traditional balance fund investors. This could be more skill-based sources of return as opposed to market-based sources of return, or it could be opportunities that fall between the cracks between the major asset classes. And finally, the fourth part is around portfolio protection. At various times in the market cycle, we'd like to take out, or we do take out, put option protection and also use cash and fixed income to protect the portfolio and smooth the investment journey. When looking at new opportunities, we're looking for 2 things. One, that we've got high conviction that it's going to meet our CPI plus 5 return objective. And secondly, the investment will add diversification to the portfolio. We also look at dynamically managing those exposures over the investment cycle. And there are typically 4 stages to the investment cycle. The first stage is usually the recovery. That's when investors are quite sceptical about the recovery taking place. Earnings growth tends to be strongest in that area and valuations are cheap. We're starting to add back market exposure at the early stages of the recovery. As optimism builds, we move into the sweet spot for markets, and that's when we're fully invested across a range of different asset classes. The third stage is a mature bull market. Valuations tend to get extended in that period, and we're starting to de-risk the portfolio, adding cash, adding as much diversification as we can, and also portfolio protection. The final stage is a bear market. That's where pessimism creeps in and markets sell off. We're defensively positioned at that point, and we're selective about what positions we're starting to add back, and portfolio protection, which is in the portfolio at that point, is rolling off. The 3 key features of the Perpetual Diversified Real Return Fund are: we have a very broad investment universe. 2, diversification is embedded into the portfolio. And 3, if we don't have high conviction in it, we don't have to own it.